Show you how this trading strategy works on the price chart. As I mentioned before, this strategy uses two time frames. On the higher time frame, we analyze the market structure to find the direction and key supply and demand areas. If you cannot clearly identify a trend, it's better to move to another pair rather than forcing yourself to find a trade. To find the direction, pay attention to market structure, swing highs and lows. To mark the key supply and demand areas, identify the zones that created imbalance, or mark the candle where three momentum candles followed. In this example, here we have a key supply area. When price taps into this level, we expect a rejection to the downside, possibly giving us a good trading opportunity. First, we wait for price to enter our trading zone. Then we zoom into a lower time frame to find an entry to go short. Never enter too early before price returns inside your range, because the market often takes out early traders. This can result in a move in your predicted direction, but only after stopping you out. Now let's zoom into a lower time frame. Now on the lower time frame, we have a clear short-term uptrend. We want to look for a reversal signal and enter a short trade against the lower time frame trend. That's why this strategy is called a reversal setup. However, even though we are trading against the lower time frame trend, we are still trading in line with the higher time frame direction. Here, I'd like to explain two powerful entry types. You can use either of them to enter a trade. The first entry type is a change of character combined with a liquidity sweep. A strong trading opportunity appears when price sweeps liquidity above a previous high, followed by a clear change of character. The liquidity grab shows that buy-side liquidity has been taken and early buyers are trapped. Then, the reversal is confirmed by the change of character, where price breaks the most recent higher low and shifts the market structure to the downside. But keep in mind that all of this price action happens at a higher time frame supply level. So we are not just trading blindly in the lower time frame. After that, we can wait for a pullback to a new supply level or a fair value gap to set our short trade. The second entry type is an inversion fair value gap entry. If an inversion fair value gap forms after price enters a supply level, it shows a strong shift in momentum. This is a powerful reversal signal and can create some of the best trading opportunities. We place a sell limit at the start of the zone and set our stop loss above it. For targets, you can aim for a solid 1-to-2 or 1-to-3 risk-to-reward ratio, and then set your next target at the next key level ahead of price. Another approach is to trail your profits, which can sometimes lead to very large risk-to-reward trades. Trailing profits works like this. When you enter a trade and the price moves in your favor, move your stop loss just below the new swing low. If price moves again, adjust your stop loss below the next higher low. This way, if price reverses and hits your stop loss, you won't lose money. It reduces pressure and helps lock in profits while keeping you in the trade for as long as the trend continues. Continue using this method, but always set a final target for your trade. If the price keeps moving in your favor, you can achieve large profits with minimal risk. Now, let's look at some examples on the price chart to fully apply this trading strategy. Here we have pound dollar on the 15-minute chart. As I mentioned previously, we're going to use Price Action Toolkit indicator to apply smart money concepts on the chart. So, from the indicator settings, let's apply the fair value gap, break of structure, and change of character. Now we can see that price is clearly making higher highs and higher lows, with strong breakouts to the upside. This means we are bullish on this pair and only looking for buying opportunities. The latest impulsive move has created large fair value gaps, which show strong buying momentum. We mark the candle that created these gaps as our demand zone. If price pulls back to this area, we expect a rejection to the upside and a possible trading opportunity. First, we wait for price to enter our trading zone, then switch to the 1-minute chart to execute the trade. On the 1-minute chart, we can see a clear downtrend, which is simply a pullback into the higher time frame demand zone. We want to see reversal signals and rejection from this area to open a long trade. However, if the price breaks below the demand zone, we take no trade. As we move forward, we can see a clear change of character. We also have an inversion fair value gap and a new bullish gap forming. This is exactly the type of reversal signal we were waiting for. We can place our entry at the start of the zone and set our stop loss below it. Our target is the higher timeframe supply ahead of price. Remember, always follow a solid risk management plan and never risk more than you are comfortable losing, keeping each trade within 1 to 3% of your capital. Now, here we have the euro-dollar on the 1-hour chart. Let's apply BOS, Chalk Plus, and fair value gap from the indicator settings. We can see a clear downtrend. We mark the candle that created the gap as our supply zone, and include the wick as well. Now we wait for the price to return to this area, then move to a lower time frame to find confirmation for a short trade. So we switch to the 5-minute chart. On the 5-minute chart, the price has already made a change of character. We can see an overlapping area of an inversion fair value gap and a new bearish fair value gap, forming a strong supply zone. This gives us a good reason to open a short trade. As the price moves forward, it drops and creates another bearish gap. Without closing the first trade, we can open a second position with reduced risk. As price continues, it returns and activates our first trade. However, the second trade becomes a loss if we do not manage it properly and secure some profit. Losses are a normal part of trading, and even professional traders experience them regularly. What matters is having an edge that grows your account over time. Also, avoid unrealistic expectations. Professional traders typically achieve around 30 to 100% returns per year. Chasing unrealistic profits often leads to a cycle where you keep switching strategies after losses. This cycle of doom happens because you are aiming for results that no strategy can consistently deliver. So guys, I hope this video brought you some value.